So I'm going to start here, guys. This is it. This is the new book, Financial Literacy for Dentists, an Entrepreneur's Guide and Insight. And this is insight from me, all of the stuff that I've learned over probably the last 40 years, 40, 42 years in dentistry. But I'm teaching how to be in business for yourself, but not by yourself. So it says the guide empowers dentists to think beyond the chair. And that's what I want to do. I want to convey that to you, to master business and money and the mindset. So I wrote this book because this is stuff that you will not, I guarantee you will not learn in school. They just don't teach it. Nor will anyone sit down with you and be able to convey this, what I'm going to give you. So it's worth millions of dollars. I'm telling you, I'm at the end of whatever career life. So I'm giving you all of this. I'm going to do it over a 12-week period. So it's a 12-week countdown starting tomorrow, which is February 1st. Yes, today is January 31st, and it is a beautiful California day. You would not believe it. This is a beautiful California day for all of you guys that are in ice and snow and so forth. I know I like the snow, but I wouldn't want to be there. But anyway, this is what I'm going to teach you, and I want you to really follow this. And if you really want to stay up on it, entrepreneurdentist.com, that's the website, entrepreneurdentist.com. And check this, Mayday. Mayday is an alarm, an alert for just emergencies. So Mayday, if you're having anything that's an emergency, I want you to be in May 1st, 2020 in Las Vegas. We're going to give you the exact hotel because now we're right in the midst of this 12-week countdown on what hotel we're going to be at. But that's the same time that Henry Schein is having their big event, and all your dentists are going to be there. I'm telling you. You can take a lot of time out to learn a lot of these clinical skills. You already learned a lot in dental school, and if you matriculated through your master's program or whatever, you learn all of these clinical skills. But then take a little bit of time to learn something about finance and economics. And I'm telling you, I'm the guy that's going to teach you a lot of these things. Even if a person knows, most of the time they're trying to clog it for themselves. So here's what I do, and this I'm a mentor, but I want to do it. So go here, and then you'll find the mastermind and the different things that we're doing. You want to join. We're doing a podcast and then the books, and I'll talk more about that. But this is basically the thing I'm trying to convey right now. It's a new thing that I did, and over the years, I started with I was one of the early DSOs. In 1994, I formed the DSO because California had a restriction. You couldn't have but two offices in your name unless you set up a MSO. So we call it a dental MSO. But I was one of the early ones, and didn't realize it until later on that because that was a structure. I went to the attorneys that set it up, but nobody told me that I was kind of early in the game. This thing that we form now, because I did that and I had all associates, I was very successful. I would consider myself to have been very successful, and I exited. We had what is called a liquidity event. And when you have a liquidity event, it's actually selling the business. But I went through the investment bankers and so forth, and then, it's a whole game that if you're not there, you gotta just learn some things about this. But anyway, we sold the asset to a private equity. So they owned a company that acquired it. But, the whole time I owned that DSO, all of the other doctors were associates and they were working for me. Some of them I mentored, and they went and set up businesses down the street. I sold some of them, some of my offices, and they started, and the names were almost the same, and some of them took some of my staff. And I always said that, wow, if I had a structure, whereas I could bring these doctors in and train them under me, and we could work together, and then they could start their things, but now we're partners, then that would have been a hell of a lot better than the attrition that we experience going through this. And you're constantly bringing in doctors, and then they leave because somebody offer them, $400 or $500 or $5,000 more of a signing bonus or something like that, which is just crazy. But that's the way it is. And people are moving like that because that's their mindset. But what if you could change your mindset and it becomes more of a thing, whereas now you have equity? I'm going to show you how, but on this, I want to talk about what the three levels, and I use the three because three is actually a universal thing that happens. It's a pattern of the universe. One, two, three. And one, two, three go one, and that's simplicity. So I want to keep it very simple. And almost everything that we discuss in the whole 12 weeks and beyond will be three yet one. It'll be based on things like that because that's the way I was raised to understand things. So anyway, when you're at the holding company and the real estate, that's one that you don't need to think about. But let's talk about this. The partner dentist. You become an employee and you work. You want to own something. You want to own some equity in something that's already established. That's an ongoing business that has performing assets or equities that are performing and have a history of it and have systems and processes that makes it where they can scale or replicate over and over and over again. That's the systems that you develop for business. So I study business. I'm telling you, I have a lot of things that I want to tell you about as far as business and how we're going to go into it. But over 12 weeks, you're going to learn a whole lot. I'm going to do a video at least once or twice a week. And I'm going to actually publish content. And you can just go to entrepreneurdentist.com. I'm going to do it for 12 weeks because it's it's a challenge for me to discipline myself to actually do it, but I want you to meet me in Vegas on May Day, and I'm really going to go through the whole day of and I'll have some people with me, but we're going to cover so much as far as business. But here, the whole thing is, if you want to be in business for yourself, but not by yourself, then the ideal thing, and this guy, Richard, with the law firm that I'm working with now, he just simplified it because I jumped around to a lot of different law firms trying to figure out how to do this thing. But he simplified it. He said, well, set up the DSO, but here's the thing you create are tracking units. And then at the tracking unit, it's like you have an office over here, office over here. You could have affiliates, but let's say you have these offices. And then down here, where you have clinical employees, each one, and you know this, your S corporation, or what they call a DPC, a dental professional corporation. But there is just the only thing that really happens as far as business here is that services are rendered, but there's high liabilities there. And here at this level where you're rendering services, so all of the assets are held at the holding company. Here are where the services and the equity is. And let's take this unit here, this tracking unit, TU number 2. And let's say we have two doctors. I'm going to call them Dr. Cash and Dr. Flo. Dr. Cash and Dr. Flo they're still making the money that they would as an associate. They leverage their degree to get equity in the company. So I'll tell you more about how that works. But I'm telling you, this stuff, it's taken a lot of years. It didn't just come to me. But once I really discovered it, it reminded me of what Trump says, stable genius. I know it really is. It's the idea itself. And listen, I want you to do this. Don't take my word for anything that I say, but don't go ask your cousin or just your CPA or your attorney, because if they're not millionaires, how the hell are they going to evaluate something that they have never been through, and they don't know if they're not there and they're just trading time for money? Then their evaluation on something that's well above their head might. So here's what I would advise. And I'm going to really advise you to do this, not just for the stuff that I tell you, but anybody that tells you this. And I hope my son will listen to this, especially at this day and age. Google has Gemini. The other two are ChatGPT and what's one, the Microsoft or whatever it is that I have on my phone that I can't remember the name of. Hold on. I have it right here. It is Claude, cousin Claude. So listen, anything like this, it's a little bit more complicated than most of these guys that are billable hours. Most of those guys, they don't know. So I'm telling you, God, I'm right here. My air conditioner came on. My son should turn the air conditioner on. Hopefully you can still hear me. But if they don't know, stick it into Claude or Gemini and run it by, ask, is this a genius idea and the opportunity? I'm telling you, it's been years, so I wouldn't be putting it out there unless it's really been evaluated. And you have to vet every idea. Everything should be vetted, but just don't vet it to your cousin or the guy that supposedly has a degree and this or that. If they're not making real money themselves, how the hell are they going to tell you? And that's all I'm saying. So I want you to, first and foremost, before we get into anything, almost every entrepreneur out there, anybody, especially over the years, every entrepreneur has read this book, Think and Grow Rich. It doesn't say think and get rich. Think and grow rich. It happens over a period of time. So you have to have a plan and you have to start somewhere. And that's the way that you build it. You start with a plan, and you have to have that mindset. In order to develop the mindset, you need to read. Read the things that'll put you on the right path. There's a hell of a lot of stuff that you can read. And then people that have come to me recently and said, well, Dr. Lanier, should I go to business school? I don't think so. Start like this. Read the book first. There's a hell of a lot that I can convey, and you may never need to go to business school. I'm telling you, that's what my plan is, to convey that kind of stuff to you. So read this one, Napoleon Hill. It was written during the 1930s. So right there, when you had the stock market crash and everything, but after that and so forth, how people that got rich, how it happens, and the mindset that you need to have in order to get there, and I'm not trying to take you way off path from the norm of who you are or what, but if you're going to get someplace that's different than where you're going and where everyone else is going, you're going to have to do things a little bit different. Like they say, doing the same thing over and over and expecting different results is the definition of insanity. And you don't want to play that role. Just think and grow rich. So what I was telling you about are these tracking units and owning shares in the tracking units. No, it's not very much different from owning public company shares like Apple. And so the key message that you're going to get from this is you own the profits and the growth, not the physical equipment. So let me just reiterate the books. Read the books. And start with Think and Grow Rich. I would imagine you already read my book, The Entrepreneur Digest. And I don't want you to fret right now. You'll read it. I'm telling you, if you really understand what I'm saying, you're going to read it. I look back, and this was written back when, 15, 17, something like that. But how to exit. That's the big word in there, how to exit. Most people don't have any idea or haven't really considered how are they going to exit. Once you're on this path, how are you going to exit? Everybody, you're running on a treadmill or something. You do know how you're going to exit. You're going to slow it down, or you're going to jump or something like that, but you have to think, what is your exit? So here your exit is, do you exit well? Or do you exit badly? Do you have the right kind of thing, whereas you don't lose your momentum or your money and so forth, but you get out and you're safe, and it was a good thing. It was planned. So you have to have a plan. So everything starts with read the books and think. So with Apple, let's say you own some shares of Apple. You don't own the store. You don't own the physical facility, and you don't own the Apple product. What you own are shares or equities in the company. And those things, Apple has had fast growth, but you see the ups and downs, because with any of those companies on the stock market moves based on investor sentiment. So if someone is scared or something happens, everybody gets scared, stock falls. Don't mean they're not still selling iPhones and iPads and so forth, but investors, they'll spook and they'll sell their shares. And then tomorrow some good news come out. But when you're in a business, you don't worry too much about that. And when you're trading on equities and so forth in the stock market, those things go up and down. And that's why they're saying really that you could just buy the averages and you're going to be better off, because You don't know where it's gonna go up mostly, and, but it's gonna have some downtimes, and it could have downs for a long period of time. But if you have a business, the business could still be making a whole hell of a lot of money while the stock is down because it's not worried about what's going on elsewhere. If you have the right business, if it's not just consumer or whatever, as long as the business is happening. So with public companies, you don't own the building or the machinery. You don't own servers or equipment. You don't own the equity. No, I'm sorry. You own equity in the business. And that's mean you own shares. You own shares in the business. And that's what is really important. You own the shares until you liquidate, sell your shares. And then you have capital gains and you pay capital gains taxes. But if you have capital gains depreciation or write-offs on something else, then it's wash. So those are things that we'll talk about later. But the benefits are this: some stocks, not all, pay dividends. So you might get profits distribution and you get growth in the value of the shares. So you getting growth in the value of the shares. And when you sell it, that liquidity event in the exit is your stock sale. So whatever it goes up in the value, now you sell it, and that's your profit that you made. So same thing here. If you're watching this as you grow it from zero, it could, because we do de novos, so it's easy to know where you start and where you're trying to target to be in 4-5 years. So if you reach that, now your equity that you built yourself and whomever else is working, their partners in the business with you. And that's why I say Dr. Cash and Dr. Flow, because they're the ones that's watching it. So that's why it's called a tracking unit. You're tracking profits, or EBITDA. You know what EBITDA is? Earnings before interest, taxes, depreciation, and amortization. Those are just some business terms to say what we're going to do. Is like stepping on it or put a cut on it. And those are things that happen after, all of. So to simplify it, they just say, well, earnings, and with earnings, the only thing you have to worry about with earnings is in EBITDA is profits. And we're going to simplify it and says revenues minus expenses is profit, or my EBITDA. Revenues minus expenses is a profit. And that's the only thing that you have to track. And that's why they're called tracking units. And you can track what your production is, but you can track, and you can have some kind of effect on the revenues. You can push and generate a lot of revenue, production, collection, and so forth. And you can have a lot of effect on what your expenses are. What kind of material, how many staff did you use? Were you very efficient and very effective? Were you producing and using, the right procedures? Are you doing things? Are you marketing right? Or is your customer service good? So you're at the level where you have control over certain things. So the idea is control your controllables. The things that you shouldn't worry about is if the marketing or the management services from the support team, if they're doing their thing, you don't worry too much about what they're making, how they're doing their thing, or whatever. Control your controllables. That's a principle. And principles are very, very important. Principles are the things, because principles remain the same. It's the manifestations that change, but principles remain the same. So if you learn the principles that I'm trying to convey, it works across. It doesn't matter what business or what you're doing. You can pass it along to your kids, because it doesn't matter. It's the principle. The manifestations or the particulars change all the time. A lot of times people ask me, well, Dr. Amir, should I get this or that in my office and do certain, those I can't really tell you. I haven't practiced dentistry. I'm still licensed. I keep my license active, but I haven't actually practiced in probably 15, 18 years. I every now and then I've done a little prophy or something for a patient. But basically, I run a dental business. I've done a lot of thinking. I've done a lot of studies and so forth. So I'm here to help you really get to the point that you can become not only profitable, but wealthy with the plan. So I'll give you more on this. But a tracking unit, you have shares. You don't own the chairs or the x-rays or the CBCT. You don't own IT equipment. You own equity in the tracking unit business. Now, the benefits of this, you get profits distribution. Like they were saying about stocks, you get dividends. Here you get profits distribution. And once the bills are paid and your share, once the shares come, you get a K1 that tells how much goes to you, how much goes to the other partners, and so forth. So now you're getting, and if we do, and which we are for the selected ones, is owner financing, you put zero in. So anything that you make on there is just infinite return on your investment. But I'm going to show you how this thing works. You make a hell of a lot of money. But the thing is, you got to think. Because a lot of times we're just following along because that's the way we've been conditioned. Go to school, get a good education, then get some more education. And if you want to, get some side education. Now you really think you're the shit. And you walk out and you think, well, I need to get paid and a hell of a lot because I'm an educated fool from an educated school. Let me do it. But I'm telling you, you got to learn something. Think for a minute. The benefits of owning something, because if you don't own anything, and here you own the rights to the profit share, you see, and that's the thing that you own the equity. You don't own the chairs, the x-rays, the assets. You own equity. And the same thing with Apple. You don't own the assets, you own equity. Same thing. I'm telling you, it's taken me a hell of a lot of years to come with this, and a lot of people that I talked to that could not do it until I met this guy Richard, who made it simple. I guess in another company, some of the other law firms that I tried, I think they did give it to me in a kind of different form, but it didn't make sense for some reason. You know how you can hear something over and over and over again, but you don't hear it until finally somebody, and then all of a sudden a light bulb goes off and you're like, damn, that's it. And that's what happened when I was talking to Richard. He was like, well, doctor, here's what I've done. And he had done this with a group of physicians and so forth. He said, you establish tracking units. So you have your DSO, and then you set up the tracking units, and you track equity in, have partners, and they track EBITDA. And that's the only thing you need to track is EBITDA or profits. So it's called so you say one office is a tracking unit, and you own the equity in that tracking unit. So, and again, the business benefits is you get profits distribution. No, that's after you pay, of course, your debt servicing, and debt servicing means, of course, you finance the loan for your percentage. And during that time, we do like a 10-year amortization with a 4 years, you're paying interest only. And then at that 4 years, now your value in the company is way up here. It's easy to go out, take out a loan on that, not even your personal. You're taking out a loan on your ownership of the equity, of the cash flow. You own the cash flow. So during that time, you get appreciation in equity value. And now if we have a major liquidity event, now we exit the whole platform, you're in on ground level. So it could be an exit between 8 and 14. The last exit I had, which was small, I owned everything, was 7. And I said, well, why can't I get to 14? And I'm going to show you how you can get there with me. So like I said, with any of these equity, like in the stock market, ups and downs, sentiment, investor sentiment, different thing. Whereas with this, it's not going to be just straight line like that, but I guarantee you that over the period of time, and my slide isn't in there right, it's too big. But anyway, the top line is revenue, and it goes to $3 million. And the profits normally run about 30%. That's what we refer to as your margin. What's the margin? The margin is somewhere between 25 and 35, depending on the specialties and whether you take any kind of Medicaid or Medicare, or you're just straight, so let's say 30%. Could be a little less, a little more, 30%. So 30% of the $3 million is what? That's $1 million. So if you were to exit Then if we were to exit, well, if you exit, let's say you just want to sell at that point. Once you refi and have a bank take out the owner's investment, and now your value in there is somewhere between 4 or 5. And if you do the things and you exit at 5, you're still $1 million in value. But if you were to, did I do it right? I think it is. Yeah, $1 million. Yeah. So what you're doing actually is you're taking an option and with just a signature. You get an option to buy in at this ground floor level here, and then over a 4-year period, you're exiting with a value of $1 million for your 20 or 25% share. I think I said 25% share. If you were 25% share right here, or 20, anyway, it's $1 million minus whatever your debt is on that, because you still got to pay whatever the debt to get in there. But what a hell of a props. And nobody that you're going to run into can set you up and tell you how to pull something off like that. I'm telling you, and they're not going to tell you. If they do, you call me, and therefore I won't refund everything that you ever gave me, because I just don't think it's out there. They're not going to tell you. But listen to this now. Remember this, because this is worth millions of dollars right here. Fame and farm, two acronyms that I want you to really get down. Now, here's the thing. Fame is forced appreciation multiples of EBITDA. So, and I'll tell you how you force the appreciation by getting in there when it was at 0, and you and Dr. Cash and Dr. Flo have pulled it up to where the revenues, that office is now producing $3 million. May have, other partner or other associates come in and work, but whomever, or hygienists or whomever that have worked in there, but you guys produce $3 million. That's, you force the appreciation. Now your value your value has appreciated, and now the value started out at pretty much 0 with debt, and now it's up there to the point where it's $1 million mounted minus whatever debt. You force the appreciation multiples. Now the multiples, rather than being worth whatever, now it's 5 times EBITDA. So you force the appreciation of EBITDA. You force the appreciation multiples of EBITDA. Now your EBITDA is $1 million times 5, and that's $5 million times, divided between the partners, and your part comes out to $1 million. Now the farm is this: forced appreciation rent multiples. Now this is the big boy stuff as well. Now this is having to do with real estate, and that's why I say at the top. But I don't want you to jump to real estate yet, because when you do the real estate, you have to have some kind of platform, because if you're in there and you're the only guy that's in there and everything depends on you, what if you don't do it right and you didn't make a good decision going in buying the real estate and so forth? It works for some people, but I'm telling you, I would really focus on fame first and then farm later, force appreciation rent multiples. And I'll explain that as we go. But remember those two acronyms. So going back to the tracking unit, basically it's options. It's like an options contract. You sign, rather than putting money down, you just sign your signature. That's why I say a license is actually a license to print money. If you knew what you were doing, you could print your own money. So you take an option contract. I have an option on some real estate that I've developed, and I locked in a price. I got an extension of time that I can do a certain thing, build it out, get it started, refinance, pull money out, and pay the original price that they were asking for, and do some things like that. But I'll share those kind of things. I'm telling you, that stable genius I'm telling you about. I've been telling you, listen, it is easy once you, not easy. It's not easy, but it's simple. Once you really understand, none of this stuff is easy. If it wasn't, everybody would be doing it. But I'm telling you, once you understand it, it is fairly simple. But the other thing is this: your fear will prevent you from doing it. See, our limitations are set by ourselves. So all of our limitations are pretty much self-imposed, and most of them by fear. fear will hold you back. And most of the time it's good, because if you don't know what the hell you're doing, you should be afraid. But that's the reason you want to have some partners and some resources that you trust that do know what they're doing. So, but what I was saying, after the 4 or 5 years, you refi, and then if there's a liquidity event, whereas the whole is greater than the sum of the parts, that's that liquidity event where you sell the whole thing, and then you can reach multiples of 10 or more, so even conservatively. Like I said, when I went by myself and I had not had the kind of growth that I'm having now, it was a 7. But if you can imagine a 10 or 12 or 14. But if you did in those 4 or 5 years, and you only, had that $1 million in EBITDA times 10, then your 20% equity in that one thing would now be valued at $2 million minus your debt servicing, whatever it is you pay off. If that's the case, then that makes so much more sense than only being W-2, or even, well, I'll 1099. And those, a lot of times, especially in California, you can't just pay it on a 1099. Sorry. Anyway, those are things so much different than a W-2. You need a W-2 a lot of times because you got to work and you got to have money. There's nothing that really comes free. So you got to have, you're in there working, but you're forcing the appreciation of whatever it is, the equity in whatever it is that you're working on or working for. That's important. And the other thing to be important, don't go out there just because you have the degree and think that you could do business. If you don't have any kind of business acumen, you don't really understand the things about finance and all of the holes out there and what you could step into, the marketing, the management, the things, the headaches that keep you up all night, and the things that are going to come at you. You don't want to do those things by yourself. But anyway, let me go back to a side-by-side comparison of public company and these tracking unit shares. So in a public company, no ownership in physical assets, equity is in the business only. Remember that. And now with the tracking units, no ownership in equipment, equity in the tracking units only. The benefits: if it's public shares, you get dividends. If it's a tracking unit, you get profits distribution. If it's public company stocks, you get growth in your stock value. Here, you get growth in equity value. In the stock market, sell or liquidate your shares and whatever you get from there. Here, you have an exit, and your proceeds could be anywhere from 8 to 14 if it's a liquidity event that we go through. If you sell before, of course, you're getting more market rate, or what we have contracts like buyback, to buy back from the company at a certain multiple. But that's to be discussed a little further. But basically, what I want you to understand is cash flow. I'm telling you, this is MBA level stuff, but it's very targeted. A lot of times you could go to school and study stuff that really is all over, and you could come out and you'll be thinking and so forth, but you didn't do anything. So your cash flow statement, a financial statement, it aggregates a company's cash inflows and outflows. You see, so you got your inflows and you got your outflows, and what's left is your EBITDA. There it is. There's your money. Because this came in, this went out, this is what stayed, and that's the only thing you're tracking. You see, that's what you're tracking. That's why it's called a tracking unit. You generate revenues and you generate expenses. The difference in the two is your profits. So in summary, owning shares mean you own the profits and growth, your appreciation, not the physical assets. Both public and tracking unit shares represent equity in the business, not physical assets, equity. Public company shares offer dividends, growth in value, and stock sale liquidity, whereas tracking units, shares, profits, provide profits distribution and strong exit of proceeds at this 8 to 14 times EBITDA. This is, I'm telling you, this is genius level stuff, guys. Especially if you're in the dental field, you can I'm telling you, run it through AI. Don't just take my word for it. So I'm going back here again and just saying a tracking unit, and the tracking unit leases things from, so these services, they have a management service agreement with the holding company or the DSO, and they provide services. So the services that we have TKO services or TKSS support services, and that's what it is. Support services, you lease that and you lease the assets, whether it be equipment and small and large equipment, so forth. So you don't really have assets here because here's where you have a lot of liability. And if you get sued, and you don't need to worry about that. Am I going to own this or am I going to own that? No, you're not. You're going to own your profits and the equity value that appreciates while you're in there. And that has a hell of a lot of value. Think Apple. Don't think your cousin and what you're used to, because we're conditioned. We're conditioned. And if you were to go to get a bank loan, then they're going to say, well, you got to own this and own that, and then we can hold this. And that's why I don't deal with the regular loans and banks and partnering with people, because I know and I've been through all of that. And we have a whole different process, to capitalize our things so that we keep it going. But I'm telling you, you can participate. And I understand skepticism and hesitation, procrastination. But if you really want to evaluate it, plug it all into Chat GPT, cousin Claude, or go. And I also like Gemini. I like all three. I'm using those three. I know there's a plethora of all kinds of AI kind of apps that are out there. I've used all three because I plug it into all three and see how they come back, which one I like the best, and so forth, and how they speak to me. But I'm telling you, don't go get your cousin Fred, get cousin Claude or somebody else and run it through something that's smart. I'm telling you, not everybody out there, even people that have law degrees and uh, and the CPAs and all of that, if they don't have, listen. And I'm not trying to put off on anybody, but if you're talking about really being an entrepreneur, if they were such an entrepreneur, why are they trading time for money? They haven't figured that part out. But their services, I need all of them. You need them, and I need all of the people around me. But I'm saying, if it comes down to making an entrepreneurial decision, talk to somebody that understands, and don't just talk to people now. Talk to AI. It's smarter than all of the people that you can come across. If you can ask it and give it the right prompts, it'll give you the answer and can evaluate better than most people can. Are you tracking? Tracking units is what it's all about. So that's my question to you. Are you tracking? And I want you to really go to the website, the entrepreneurdentist.com. But your first assignment is Think and Grow Rich. Napoleon Hill. They say it's about a 6-hour read. I have about 3 different copies. I don't know why. Over the years, I given some away, and then people have taken mine, or I lost some and then I found it again. But I do have a large library of books, and that's one I think you could start with. There's a lot of books I'm going to have you go through this is a good one. Robert Kiyosaki got a lot of books, but the one I think and I've read most of them, Cash Flow Quadrant. If you get into this, you'll understand a lot. But you got to read Cash Flow Quadrant. That's another one. Over these 12 weeks, I know you're studying all kinds of stuff, but if you really want to be an entrepreneur, you got to study entrepreneurship.